Bhargav will obviously just take you through with the performance update for the funds and our macro theme in for the month, and also the newsletter that we extensively wrote on the big question in everybody's mind on the rural recovery, followed by the macro update that I will take you, and the subsequent Q&A sessions that we'll be more than happy to address. Without taking too much ado, I would hand over to Bhargav to begin with the proceedings. Over to you, Bhargav.
Yeah, thanks, Tilok, and good evening, everybody. Let's start with the performance of the month. So starting with Coffee Can. So as you can see in the presentation, the month of January, Coffee Can delivered minus 2.4% return versus Nifty's return of about 0%. But the good part is that whatever new stock additions have been done in the Coffee Can portfolio have started to fire. So if you look at KFIN, which was added, is up 15%. For the month, Bharti is up 14%, and Bajaj Auto is up about 13%. The have been HDFC, which is down about 14%, followed by LTI Mindtree, which was down about 14%, and Eicher, which is down about 7%. And for the full year, CY23, the performance has been 16.4% versus Nifty, which was up about 21%. If we move to GNC, if you look at CY23 as a year, GNC has done extremely well with a performance of about 32% for the full year. So after CY22 being a weaker year, CY23 has come back strongly. And if you look at underlying BSE 500, the returns were about 26.5%. January, however, has been a little weak, but February so far has been extremely strong, thanks to a very strong performance by Trent, which is up almost 50% in the last week. Coming back to the performance of January, so January the returns were about negative 2.2% versus positive 1.9%. But I'm sure, given the kind of month February has been to start with, will more than make work for the alpha loss as far as January is concerned. Our performers in January were Blue Star, which is up about 21%, Persistent, which is up 13%, and Kajaria, which was up 5.6%. The laggards being AU, which was down 19%, Laurus 11%, and Supreme 8.4%. Coming to emerging giants, if you look at CY23 as a whole, the fund was up about 24.6% versus BSE 500 being up 26.5%. In the month of January, if you look at the performance, it was up about 0.2 versus 1.9 for BSE 500. In terms of top performers in January was Mass Financials, which is up about 15%. Venus Pipes, which is a new addition which we did, is up about 8%, and Home First, which is up about 6.4%. The laggards being Raj Ratan, which again is a new addition, which is down about 13%, but we expect it to come back very strongly over the course of next couple of quarters. Orient, which is down about 8%. Orient obviously has reported very strong numbers, but it's basically the CEO who's missing is leading to the stock not performing. But we believe that the CEO, as highlighted in the conference call, should be on board in the next 3 months, and that could fuel a lot of re-rating. And Moltec, which is down about 8%. Moving to 10x, 10x, if you look at the full year performance, it was at about 30.6% as compared to BSE 500, which was at about 26.5%. January again has been a tough month for 10x, but 10x has done very well starting February, thanks to Trent, which was again one of the large positions in 10x. So both the GNC and 10x have done very well starting February. If you look at January, it was down 3% as compared to benchmark, which was up 2%. But as I highlighted earlier in the case of 10x, that given the kind of start which February has, there is a likelihood that we will more than make over the underperformance of January. In terms of top performers have been persistent, which is up about 13%. Venus, which was added in emerging giants, has also been added in 10x with a performance of about 8%, and Syngene, which was up about 7%. Laggards being AU, LTM Mindtree, and Metro, which was down about 13%. Yes, so let's come to our newsletter, which is what is our take on rural recoveries. So if you look at this particular slide, and if you look at CY23 as a year, we've seen a lot of rural-focused companies seeing significant underperformance. So the likes of V-Mart, Dabur, HUL, Relaxo, they've all seen significant underperformance with regards to BSE 500. So most of these names have ended up with a negative share price return versus BSE 500 rewarding handsomely. And if you look at their underperformance, the main reason for the underperformance has been also declining margins. So if you look at Dabur, Maruti, Hero, HUL, Relaxo, they've all sort of reported significant decline in gross margins as far as last year is concerned. More on the next slide. So if you look at general media commentary around rural, it has been fairly negative. So from media articles which says that rural going through a lot of stress, and that is also being reflected in the commentaries of many of the listed companies in their conference call. So the consensus is very clear that the rural is in stress. But what we did was that we sort of thought of avoiding the noise, and we thought that let's go back to history and just look at how the macro indicators have shaped as far as the rural economy is concerned. So we found a lot of contrasting data points. So if you look at the first chart, which is on the left-hand side, what we see is that actually the unemployment scenario in India is not that bad. In fact, the unemployment at the country level has been only declining. And in fact, the unemployment is now significantly lower as compared to pre-COVID levels as well. And if you look at LF PR in rural regions as well, it has sort of increased from about 50.7 to 60.8. So LF PR is basically the labor force participation, which shows that essentially things are not that bad. If we look at the second chart on the right, which is Manrega, what we see is that the number of days for which one opts for employment under Manrega has actually been falling. So typically what happens is that if there is no employment opportunity, then people get rolled into Manrega for employment. So the fact that the number of days for which an employee is choosing to get enrolled under Manrega is falling, it shows that there are employment generation opportunities in other sort of formal sectors. So which clearly shows that there is not much stress, because had it been a scenario where they would have been stressed, then the number of days under Manrega would have actually inched closer to 100, which is the maximum number of days for which Manrega gives employment. And the chart on the last chart, which is on the bottom, it shows that actually, if you look at calendar year 23, for most part of the calendar year, the rural real wage inflation has been positive, which means that despite a high inflation environment, wage in rural areas have actually been higher than the inflation rate. And that clearly shows that there has been money which has been made on the rural side, and obviously that money would have also gone into consumption spending. So things are actually not that bad as far as rural areas is concerned, is what we concluded. Now, so what happened? Why did larger companies not benefit out of the demand center? So what we did was we spoke with a lot of channel partners, which includes speaking with dealers, distributors. We also spoke with things which we are sort of finding. One is that the share of organized players have actually got reduced. So it's the unorganized which has made a comeback over the course of last 1.5 years. And that typically happens when the price gap between organized players and unorganized players widen. So what happened was that a lot of organized companies actually raised prices during the COVID period on the back of significant inflation in raw material prices. And the price increase actually was much, much higher as compared to the unorganized players. And that led to widening of the gap between organized and unorganized. And resultantly, we understand that unorganized players actually took up a significant market share over the course of last 1.5 years. So, for example, if I take biscuit as a category, then players like Anmol or Priya Gold have actually grown significant as compared to, say, a Parle G or a Britannia. And the main reason for this being is the price gap between the branded and the unorganized. And the second bit which we found out from our channel checks is the fact that a lot of organized sector is seeing rising competition from organized players only who are looking at entering into adjacencies. So for instance, if you look at this particular chart on the top left-hand side, what we see is that if you look at kitchen appliances as a category, you are seeing new entrants like Havells, V-Guard, then Orient, who have also entered into kitchen appliances aggressively, and they are taking away market share from the likes of TTK Prestige or the likes of Hawkins. So there is sort of more and more adjacencies in which organized players are entering. If you look at the second chart as well, which is the fans category, Polycab, which was a cables and wires company, launched into fans. RR Cable, which again, cable and wire company, launched into fans. And then you have Attenberg, which emerged as a new disruptor on the BLDC side. Gold Medal, which is referred to as GM, which was again selling switches and switchgear, launched into fans. So many of these players who were not into fans but organized players started launching fans, and that actually acted as a disruptor as far as organized competition is concerned. So clearly, I mean, it's not that demand has been missing. It's just that unorganized players have been taking share, and within organized, the competition has been rising. And lastly, if we look at the last chart, sorry, there's an error. It says domestic fan industry market share, but it's actually four-wheeler market share. So if we look at the four-wheeler segment as well, what we see is that a lot of newer players like MG, Kia, and in fact, Tata Motors obviously is not a new player, but it has come up with several new product launches, have started gaining market share. And resultantly, incumbents like Maruti, Hyundai, Honda, for that matter, have been losing market share. So clearly, within organized, the tail seems to be wagging, meaning that the share is getting spread out across a larger number of players, is what we concluded. Now, what is happening now is the fact that is incumbent players are now realizing that it was their pricing action which has actually allowed unorganized to come back, and also other players on the organized side to enter into adjacencies. For instance, if you look at Lloyd to that extent, they came up with a fairly price disruption strategy, and that led to Voltas losing market share. So what these incumbents are now doing is that essentially they have now started taking price cuts. So we are hearing Asian Paints has cut prices by about 3 to 4%. Voltas is becoming very aggressive in terms of pricing. And that is the story across several sort of sectors. In biscuits, we are seeing prices remaining the same, but grammage being increased. So these market leaders who were losing share are now sort of trying to make a comeback. And what is good about this is that they already have a very strong balance sheet. So obviously they can sort of afford to take some price corrective actions in lieu of taking market share. So clearly this is a trend that we are seeing, that the rural incumbents are staging a comeback. And not only are they pricing aggressively their products, but they are also increasing dealer incentive schemes, which is sort of trying to woo the channel to sort of gain market share. So that's what is sort of happening now. Resultantly, what we believe is that there are a few themes which one can play around this. So a combination of sort of rural economy also coming back. Obviously, this is an election year. So typically in an election year, you also see sort of rural economy coming back. Also, macro indicators are in favor. For instance, if you look at inflation, it is now sub 6%. So clearly, there is a case of rural economy as such also making a comeback on account of favorable macros. So alongside this, what we believe is that there are a few subsectors wherein market leaders had not done well. But it's time that one can have a look at a few of these names. So few of the subsectors which we believe could do well this year is two-wheelers. If you look at their indexation to the rural economy, almost 55% of the sales for two-wheelers come from the rural areas. Other subsector could be mass apparel. So if you look at value brands have seen very difficult times over the course of last 1.5 years. And obviously now through price cuts, they are trying to make a serious comeback. Likewise is the case in mass footwear and mass innerwear as well, where market leaders in this segment had seen very tough times in the last 1.5 years. And now they are sort of reacting and coming back. So clearly, if you look at stock prices across these subsectors, they were beaten down over the course of last 1.5 years. But now that they are realizing that they need to take corrective actions, and now that they have started taking, we believe that they should start taking market share, and that could sort of be positively looked by market participants. And hence, we thought of outlining a few of these themes which one can play. So obviously this was our newsletter for the month of January, and these were our findings. So I'll sort of request Trilok now to come in and take you through macro.
Yeah, hi. Thank you, Bhargav, for the very comprehensive update. Moving from an important pertinent question on the theme that we wrote to what's happening in the economy. So we will just take you through a few things that we believe is going to have an bearing on the outlook for the economy as a whole. One and the foremost important being the liquidity. So if you observe, since in the last 4.5 years, in the last 2-3 months, we have seen a significant liquidity deficit versus a positive territory that we saw since November 20 or October 20 till basically November 23. So there are a couple of reasons for this. Obviously, that the public capex is obviously had picked up, and we obviously seen some sort of sucking the liquidity. Plus, RBI sort of several measures of tightening in context of the rising interest rate scenario. They chose to obviously tighten the tools like uh, particularly with respect to increasing SLR ratios as well as keeping the or increasing the risk-weighted assets for the several unsecured credit that the banks lend out to. Importantly, our belief is that the liquidity of almost 3.5 trillion rupees may not necessarily persist at these levels, but certainly going to remain at a you know range of between 2 to 2.5 lakh in the subsequent months to come by. Obviously, RBI will intervene in their several aspects like OMO purchases or resort to any dollar sort of purchases and all. But our sense is, until the inflationary situation in the country, particularly led by food, comes out meaningfully, they could obviously resort to several other tools beyond just cutting the interest rate or increasing interest rates in order to ensure the systemic liquidity remains either tight or sort of loosened depending on the situation that we unfolds. So moving from liquidity to what's happening around the world, as you must have seen that the freight rates because of the Red Sea conflict that we saw in the last month has moved up very very sharply. In fact, what has happened because of this absolutely uncertain situation, there's been divergence of the ships from the Red Sea to the Cape of Good Hope, which is basically this route has elongated and added a almost a you know almost a 10,000 kilometers to the whole route, and in Delhi, and thereby increasing the timeline by 30% plus. So what this has done is a delay in terms of deliveries, b increasing cost of delivery, rising insurance premium, everything, and so on and so forth. The biggest issue of this is the European continent, and we will obviously see some companies in the segment impacting because of this. Could be there are certain examples like chemicals, like autos, and certain commodities as well. But obviously, this sort of supply disruption may necessarily have some impact in the near term, but not in the mid to long term, because eventually this sort of political uncertainty and unevenness should settle down in our assessment. So this is obviously an important point to note for, because most of us believe that this particular issue would be very transitionary and should be short-lived by maybe another 15-20 days or so. But now it's been more than 2 months and this persists, which is why we wanted to highlight on this aspect as well. Moving ahead from this, the freight rates to what the interim budget was announced. So obviously, interim budget, given the fact that it was just in an interim, and we will actually have a final budget in the post-election sort of June July time frame. Two important things to note on is, despite an interim budget, government focused on maintaining fiscal prudence and obviously intended to also put some realistic numbers both in terms of revenues, both direct and indirect tax, as well as in context of the capex which they obviously announced. Notably, the revenue expenditure and capital expenditure, obviously we are very very clearly aware that has been rising over the last 3 4 5 years, but the revenue expenditure, which is probably a non-productive expenditure, has been curtailed to less than at a 2 3% CAGR since the last 5 years, which is a commendable job. Our belief is, when this government obviously going to present the new budget, they will also be more pragmatic, because they sort of resisted any populist measures or sort of vote luring sort of announcement in this budget, which is a welcome move. Although there is no taxation change, which was a widely expected move for the direct and indirect and the marginal taxpayers. But our belief is, balancing growth as well as fiscal deficit is a path that the government has chosen, which is obviously very very critical for the growth as well as the cost of capital that most of us bears. Moving ahead from budget to what's the interim earnings so far has been. So when you see the all so far, I think so 32 odd companies have announced results in the Nifty. Nearly the result obviously revenues of these companies have been, I mean, the Nifty has been 6% so far of the companies announced, and the PAT has been 20%. Our sense is, for the balance companies that will also get down, so you will see a sort of mid to high teens of PAT for the full quarter as a whole, and obviously expected in this quarter because of very low base and margin issues. Metals and cement have done exceptionally well on a YY basis, and oil and gas and auto has also done in the in the rural recovery or a sort of theme that he took you through. Consumption remains an important sort of element which remains weak, particularly the staples piece of the country, and discretionaries in select pockets remain sort of strong. However, we are also seeing some signs of moderation within the discretionary sector. But so far, it's not a sign of completely worry. But yeah, that's an area of monitoring that we are keeping a close eye on. So so far the picture in the earnings have been quite stable. Nothing much to sort of take home on. Importantly, most numbers are in line. Moving from earnings to what kind of valuations we are at. So over the last couple of months, obviously the gap in terms of discount to long term averages has sort of reduced from 8% to 3% now, but we still obviously are in now we are broadly in line with long term averages, and there is no meaningful discount. 1 to 3% is broadly not a meaningful number to sort of like look upon. Importantly, our price to book obviously has is now trading at 15% premium to the averages, primarily a function of ROE expansion. If you look around, since 2012, our ROE probably will be highest since then in 2024. So essentially, we have, and from the lows of 12.9, we are around, we'll probably close at 15.9, 16%. So that's a 400 basis point expansion over the last 7-8 years in the ROE. So a margin for the marginal premium for that in the price to book, which is obviously an important element for the banking and financial sector, in our understanding, is fairly justified. So we believe, obviously, market is sort of now it's long-term averages, and in some pockets valuations are stretched, but overall, it's not a very insanely expensive market for us to get worried on. In fact, where we believe wherever the earnings will remain strong, our belief is the opportunities lies even from here on to make sort of alpha in the portfolios and the stocks to pick on. With that, I think so.